Right. Hello, everybody. This is a view from Asia. Jeremy East, giving you an update on what I'm seeing in the regional markets and also what's going on in Hong Kong, especially. So the last time we spoke, Hong Kong was in a very good place in terms of the virus, with only just over 100 people having caught the virus. Unfortunately, the situation has changed quite dramatically over the past 4 weeks, with, I believe, almost 900 people now with the virus. This has caused quite a strong reaction from the government in terms of restrictions on the border and restrictions on public movement and business. Although normal businesses are up and running, retail is definitely quiet. This situation is being reflected across Asia and has had a knock-on effect on the gold market. In different countries, we see quite different views. So, for example, in Hong Kong and Singapore, we've been seeing quite good amounts of scrap selling. People buy gold for a rainy day, and this is a rainy day. But on the other side of that, there is demand coming through for investment bars and coins. So a bit of I would say, a two-way market going on in Hong Kong and Singapore. China, they're back to work, almost back to normal, although again, like in Hong Kong, the retail outlets are still very quiet. And speaking to my contacts in China recently, demand is still very weak, and it's been weak since the Chinese New Year. So demand in China from a retail and also from an investor perspective is low, with the Shanghai Gold Exchange trading at around a $15 to $20 discount to the international markets. Of course, this is important because gold that's moved over the past 5 years into China can't actually move out of China. It's illegal for gold to be exported from China. So in some ways, the gold that's gone into China cannot then move back out to satisfy demand in the international markets. And in some ways, it could be seen as quite lucky, because if China was importing gold in the same way as it has been over the past 5 years, then the international markets may have seen some even more extreme dislocation. Gold in China. So China has been imported, as we know, somewhere around 1,000 tons per year for the past 5 years. This huge demand in China of around 1,500 tons means that gold in China generally trades at a significant premium to the international market, and that premium could be as much as $40. In my experience over the past 5 years, China's only gone to a discount on 1 or 2 occasions, and in those situations only for $1 to $2 discount, as the market is generally trades at a premium. So today, with gold trading at a $15 to $20 discount, it is highly unusual. And really just reflective of the weak demand that we're seeing in China. However, I expect this to change as people come back to work and become more comfortable visiting their local stores. And I think potentially there will be some pent-up demand for gold, and I'd expect over the coming quarter to see the current discount in the China market move back towards where it normally is at a small premium.